Thank you, everyone, for joining us today for our annual Startup Financing Trends webinar. We're really glad to have you here. My name is Kirsten Loita, and I'm a partner at Osage University Partners, leading our university relations efforts. We'll go to the next slide. I'm joined today by three of my colleagues from OUP, Anurag Agarwal, Ajay Rayasam, and Nabil Ullah, and I'm going to have each of them introduce themselves. Anurag, could you start us off?
Hi, everyone. This is Anurag Agarwal. I'm a partner on the life science investment team.
Great. Ajay?
Hi, I'm Ajay. I'm an associate on the Tech and Physical Sciences team.
Great. And Nabil?
Hi, everyone. I'm a senior analyst here at OUP, and I help everybody.
He does. Nabil's kind of the person behind a lot of what you're going to be seeing today. So thanks, Nabil, Ajay, and Anurag. Now go to the next slide. All right, the slides and the recording of this webinar will be available on OUP's partner portal, and a recording will also be available via our YouTube channel. We'll also be sending the slides to everyone who registered. We get that question a lot. So just to know ahead of time, we will be sending the slides out to you as well. For those of you who are with our partner institutions, the partner portal is an online portal for the tech transfer officers and the researchers at our partner universities that's full of relevant tech transfer and startup content. Once you are in the portal, for which you do need to register if you haven't already, you'll find a downloadable presentation deck and video link for this webinar on the webinars page, which is under our startup resources section. We do encourage you to ask questions throughout this webinar. Please use the Q&A tool in the Zoom toolbar that you have probably at the bottom of your screen. If you submit those questions, I'll be going through them and either answering them by writing back to you, or I'll ask them of our panelists. Please do use that Q&A toolbox. It's really much easier for me to keep track of the questions there than people putting them in the chat. So we'll go to the next slide. A short intro on OUP for those of you who do not know us. We're a venture capital fund that partners with academic institutions to invest in their startups, typically by exercising the participation rights available through their licenses. As part of this partnership, the institutions share in our profits and receive programmatic support on tech transfer and academic startups, such as this webinar today. OUP is now on its fourth fund and has made over 130 investments in all areas, investments in companies, I should say, in all areas of deep science. And many of those companies have had successful exits for us, either through IPOs or mergers and acquisitions. And to just give you a taste of the types of companies that we invest in, we'll go to the next slide. We have a very wide breadth of companies that we invest in. We have both a life sciences team that invests in the life science areas, as well as a tech investment team that kind of covers everything else that's coming out of the deep science areas of the universities that we work with. And then we'll go to the next slide. So this is our agenda for today. We'll go through the trends that we're seeing as far as financing and startups in life sciences, then also on the physical sciences / tech side. We'll go a bit into, because I think this is an area of a lot of interest to folks, about what's going on in the public markets. So we'll have both a section on biotech public markets as well as the physical science public markets as well, and then have a bit of a wrap-up summary there. So as I mentioned, please do ask your questions as they come up as we go through the slides. I'll curate them and pass them along to our panelists as we're going through them. So I'm going to pass now the baton to Anurag. We'll go to the next slide to dive into the life science investment trends. I'm going to just make one more note before Anurag goes into this. You'll note in a number of these slides that we do use information from the Silicon Valley Bank healthcare report that they put out each year. And we've always been really thankful for this SVB report. It's a really terrific work, and we hope that it does somehow continue in the future. So Anurag, do you want to take it from there?
Yeah, thanks, Kirsten. So as I go through the life science trends, this will be divided into three sections that you'll see. We'll start off with the overall market, then go into more of the biopharma section, followed by devices, diagnostics, and finally R&D tools. And a lot of the content will be focused on biopharma, since that's where most of the venture activity usually is. Plus, I think it will not be a surprise to everybody, like what's going on in the broader financial market. Biotech has fallen on the knife as well. And 2022 has seen a sharp decline in the overall investment in this space and the number of deals. As you can see, very dramatically starting from Q1 2022. Overall investments have fallen from 870 billion to about 500 billion. And I think if we kind of plot the the Q1 2023 numbers, I think this trend is expected to continue. And which has been very, kind of reminiscent of the broader, the broader markets as well. However, if you look at within the overall venture activity in the biotech, if you look at different sections that is highlighted in the table below, you'll see that biopharma forms almost half of the investments, if not more, in this space. And that has significantly declined from 2021 to 2022 and is a big driver of this decline. It went from 31 or about $32 billion to 24 billion in 2022. I think the other big sector that had really seen a decline is the health tech, which went from 33 billion to only about $13 billion in 2022, while the more of the smaller activity areas like medical device have not seen that dramatic of a decline. And that is because they hadn't seen that dramatic, increase over 2021 and 2020. And therefore it was less driven by the overall financial markets versus, they were written more on the basic fundamentals of the investments there. So if we, on the right-hand side, you can just see how the gain of 2022 to 2021 during the pandemic has now completely been reversed in 2021, 2022. However, the investments still remain at quite a historic high. They have not lost all their gains, but it does feel significant from the highs of 2021, with again, health tech seeing a significant 53% decline, followed by the diagnostic and biopharma space. And I think one thing highlighted here is, the rise in 2021 is directly correlated to the fall in 2021 and 2022. And that just highlights that, the faster things grew in the pandemic world has finally come back as the world has settled to its new normal. Next slide, please. So if we biopharma is such a broad area. If we look a little bit into the different, indications within the biopharma, we'll see that there are certain indications that have, been impacted more than the others. First of all, if you on the left-hand side at the bar graph, if you see this decline really is, coming in from, the second half of 2022. And again, it will continue most likely continue in the Q1 and the first half of 2023. But if you look at the different indications, which is listed in the table on the right, the oncology seems to be the one that has seen almost a 40% year-over-year change, going from $11.3 billion in 2021 to around $7 billion in 2022. While platform technologies have relatively remained constant, and this is primarily because as platform technologies, they are applicable to many different indications and potentially could pivot into different indications as well. And so may extract value from whatever is currently the most attractive area to attractive indication. Neurology, like oncology, has taken the next brunt of decline in 2022 with 44% decline. And these two areas had what has driven primarily the decline in biopharma investment. And oncology has, I want to highlight, oncology was an area that saw such a big boom. We saw, drugs being developed for extremely rare cancers, and which have then fallen short of their commercial potential. And therefore, there has been some reversal in the market of understanding, what is an approved product versus what's a true commercial product. And that reality has hit some of the targeted oncology significantly. But on the other hand, the largest M&As are also in the space. Something like Seagen, just being acquired by Pfizer, has been one of the greatest, biggest ADC acquisitions. Similarly, Pfizer acquiring Biohaven in neurology space has been, a very large acquisition. So again, though these areas have declined in VC investment, the M&A activity in this areas in recent times may not mean that the investments are not going to continue or continue to decline, but there may be a shift within these indications on where the investments are prioritized. Next slide, please. So this is just a cutoff looking at what we had seen in the overall market to more on the lens of the university therapeutics companies. And this is based on the companies that OUP tracks, and given our broad network, it's a good representative of what the overall university ecosystem would look like. And as expected, you've seen a decade of strong growth from 2013 to 2021, with now decline in 2022, but still it's at the 2019 level, which was again the all-time high for the last 6 to 7 years. And so the investments remain robust. However, the highs of 2021 are gone, and the 2023 is expected to continue decline. And based on the overall market conditions, we'll see where it stabilizes. On the right-hand side, we want to just highlight some, what the valuation, what does it mean for valuation and deal size? And so if you look at the top quartile, deals that have happened, you'll see that 2022 has not seen any change in the pre-money valuation or the deal size. And this is kind of in contrast to the total dollars deployed has been significantly reduced. And this is primarily because even in these tough markets, the really good deals are getting done. And so what has happened is the bar for what you define as a good deal has changed. The number of deals have shrunk, but I think the good deals are still getting done at a good price and are able to raise the money. As you'll see some examples below, which have raised $100+ million rounds that we continue to see. What is interesting is if you actually plot the mean in this chart as well, what you'll see is the rise has happened from 2020, 2021 to 2022. But in 2023, Q1, the data has reversed. The pre-money has come down. The deal size has come down for the mean, but not for the top quartile. Again, highlighting that on average, the market has corrected. But for really good deals, we still get value. They're still able to raise. It's just that those numbers become less, a number of companies become lesser and lesser, and therefore the band has a bigger dispersion than what we used to see in 2021. Next slide, please. So this is highlighting, what are the different, investors who have been active by different areas. And again, not to belabor this point, but what is very interesting to see here is the difference between 2021 and 2022 numbers in the columns. Each of these investors have done significantly lesser deals. If you look at Samsara from 22 to 7, that has been, Deerfield has been an outlier where they have actually increased their number of deals. However, Janus Henderson, which is a very classical crossover round that participates in primarily in crossovers and then in public markets, have dramatically pulled back their private investments. Similar vein is Surveyor and Cormorant, and all of these hedge funds, which moved in heavily into the private market into 2021, because of the lack of IPOs, have pulled out of private markets and now focusing entirely on the public equities where the valuations are low and there is higher returns to be had. The other thing that I would highlight is the column on the rightmost column where you see oncology. The reduction in the number of deals is dramatic. Logos Capital from 19 in 2021 to just 1 in 2022 just shows how far oncology has fallen, while the platform deals, which though require large dollars, have relatively stayed, some of them have stayed the same. Arch has made more investments in platform deals. And so, because the platforms have more flexibility, maybe they can survive these times of changing indication preference compared to more focused companies. However, the cash burns can be an interesting headwinds for them compared to the tough financing markets that maybe they continues for the next year or so. Next slide. So as we, biopharma has been the primary, bulk of venture investing, and it continues to be. However, the half of the market is combined of devices, diagnostics, and tools. So we'll go through that next. And as you see, the devices actually have been quite resilient. And that is primarily because they did not see the growth that was, seen by the biopharma in 2021. So there wasn't much to kind of readjust based on the overall financial market. And therefore, the investors who are in this space have continued and maintained their discipline and investment, unlike biopharma, where the priorities had changed and now have readjusted. What you will see is, the areas that continue to be on the top are non-invasive monitoring and imaging. Those are the two big areas of the devices where the most of the VC investments have gone. However, drug delivery, and it seems like in 2021 and 2022 has become the new big area, and some of it could have been driven by gene therapy deliveries, cell therapy deliveries, some regenerative therapy deliveries, and these have reinvigorated these device markets for these areas as well. Again, if you look at the pre-money and the deal size, not significant changes in the seed Series A valuation, some increase in the pre-money valuations in this 2022 world. And again, remember that these are a little bit of laggard indicators, because some of the deals announced in 2022 first half were already done in 2021. They were just announced in 2022. So it'll be interesting to see how these numbers look next year and the first half of 2024 as the realities of 2023 and the second half of 2022 sets in. Next slide, please. Similarly, this is again a cut of university spin-out view. As you can see that the rise has not been as meteoric in the device space as you saw in the biopharma. However, therefore, the decline has been much more softer as well. Though the number of deals have declined from 252 to 157, the dollars invested have remained relatively constant, and that means that each deal has become much larger. On average, more money has been spent on each deal, which shows that the quality of the company that are getting funded is increasing as the financial markets become tighter. However, venture investments are large enough and they're being made in these companies, and maybe even more than what they were being made in 2021. And similarly, on the right-hand side, as you can see, the pre-money and the deal size have relatively stayed same and not much variability over time. Next slide, please. Again, these are some of the med device investors, and you'll see that outside the crossover, the late stage crossovers, the names are quite different compared to the therapeutic world. And there are only a very few groups that cut across biopharma and device consistently. I would call out GV as one that we have seen, RA Capital as one. We have seen them invest across devices and diagnostic more consistently, but these two group of investors tend to be quite different. And as the startups in each space are looking, their target audience should accordingly be tailored, since these two investor groups are quite mutually exclusive to the most extent. Next slide, please. Diagnostic and the tool space, and this has been an interesting space which has actually gained quite a bit momentum in 2021. And if you'll see the R&D tool section in the table on the left, that it went from 5 billion to 7.5 billion in 2020 to 2021. However, that has quickly returned back to its 2020 levels to about 4.8 billion. And there has been a lot of new diagnostics and both liquid biopsies space and the research tools that really gain momentum in a pandemic world. And some of it primarily driven through the broader financial market, which have readjusted. This seems a lot more similar to what the biopharma market had seen. However, the overall investments still are quite small, or quite a fraction of what biopharma has. Again, I think what is another area is diagnostic analytics. If you can see, they have significantly dropped down in 2022, despite being similar between 2020 and 2021, which is a unique trend that we haven't seen with the previous other two sectors. Overall, the pre-money and the deal size, there's not significant changes there. And it'll be interesting to see how all of these markets again adjust in 2023 as we get deeper into what seems like a much more continuing difficult financing market. Next slide, please. And again, this is looking at the diagnostic and tools. And if you can see, the growth from 2013 to 2021 has been dramatic. And the growth is specifically from 2019 to 2021 has been exponential, while the decline similarly has come, quite abruptly. However, I have to say, like in the 2022, some very large deals were done. Icon had raised a couple of $100 million in their Series A. Delphi raised a couple of $100 million in Series B. Xilus, which is an in vitro cell culture system, also had raised a $50 million round. So there's a lot of big rounds being done, but as we discussed, few deals will get the big rounds done. On an average, the market will be down, but the good companies with good investors, good team, good technology still can get funded because there is significant venture money in the market, as we'll see at the end of this section. Next slide, please. Again, as you can see here, this is the list of investors who invest in the most active investors in diagnostic and tools. And this is a little bit more, intersection between the biopharma and the diagnostic and tool space. Northbound, again, a very active investor in the biopharma side, also a very active and on the diagnostic and tool side. Section 32 has been a very frequent investor in the liquid biopsy space, in cancer diagnostic space. Perceptive Advisors similarly. And therefore, there have been some very late stage and biopharma focused investors who have recently moved into diagnostics and tool space as they find opportunities to diversify outside biopharma. And it'll be interesting to see how these trends continue going forward as the biopharma valuations soften, and does their focus reshift towards that, or does it stay equally diversified? Next slide, please. So with all the news on the markets being down, one thing that is interesting to see is that the venture funds that have been raised in this time is still at historical highs. If this is the total amount of healthcare VC fundraising, so this is the amount of dollars venture funds have raised. This has constantly, since 2013, has been significantly on the rise. And remember, each fund deploys over the next 3 to 4 years. So as we look at the funds raised in 2021 to 2022, that combined is $50 billion. These will be deployed over the next 3 to 4 years, right? And so there is a lot of capital in the market, and all the major venture funds have raised a new fund in the recent years. Now, that means that even though only a few deals get done, these dollars will be deployed on those deals. So we may see fewer deals, but the larger deals still being the norm as these venture funds have larger and larger funds that need to be deployed. And therefore, we may see a little bit more concentration going forward, but that remains to be seen. That how does the venture activity change, especially when the late stage funding, because of the lack of IPOs, may be drying up. And therefore, some of the early stage investors will have to continue funding their companies, and therefore maybe reducing the number of deals they can do as they support their existing portfolios. So overall, the market is ripe with a lot of venture cash. Overall headwinds from the financial markets will pay for a very interesting 2023 and 2024 going forward. I think that's the last slide on the life science side.
I have a couple of questions for you before we move on to Ajay. So one question, I think you kind of were answering this in your last comments, and the question was, were the 21 highs a bit of a COVID hangover, and so not necessarily a good comparison point? Considering that they were so high. But would that have a lot to do with kind of the COVID atmosphere that was happening?
Absolutely. And you will see this from a later section when we talk about the public companies. And because of the cost of capital being so low during the pandemic, the investment pace was changed because the view of the risk was seen differently, because the cost of deploying that capital was seen differently. So definitely 2021 was no fundamentals have changed. I think our medicines have become more innovative medicines have been approved, and therefore the innovation continues. I think this is truly an impact of the broader financial cycles that we have seen. And again, as I said, 2022 is a low, but still historical high. So we were still only at 2020 levels, which have been a high for the last decade. So the environment is still rich. It just feels like we are in a down market because 2021 gave us such a big high that I don't expect to see that anytime in near future.
Right. And then can you actually go into a little bit more of the definitions of the categories that we just covered, like what's included in diagnostic and tools versus healthcare?
Yeah, and this is an interesting question. Again, as Kirsten, you mentioned that we are taking a lot of this data from SVB. And so some of it, the underlying data is not available to us. And therefore, however, what I think of a health tech is more of the health IT stuff, more of the apps-based programs and support services. Diagnostics and devices become actual products that are deployed in the CLIA lab that are being used, or they are sent in the point of care devices. These are the things that I think we think of more of the diagnostic world. Again, however, there may be some overlap there for sure, and we don't have the clarity of the underlying data to clearly know the demarcation there.
Great. And we have a couple more questions, but I'm going to actually ask Nabil about a couple of these as we're going through the next slides, and he'll have some answers for them soon. So we'll go on to Ajay right now.
Great. Next slide, please. So as Anurag alluded to, 2021 was a historic high for both biotech and tech venture capital funding. If you would define last year in hindsight as rational exuberance, I think this year is about tempered expectations. And so when you look across the board, total venture dollars has decreased by 30%. Deal size has shrunk by 20%. But in perspective, it's still much higher than 2020 and beyond. We're still at historical highs. We're still deploying dollars. But as I mentioned, it doesn't tell the entire story. So in Q4 2022, total deal value fell by 55% and deal count dropped by 42% as well. We'll talk about it in the public market section, but clearly there's ramifications. They're coming from greater macroeconomic headwinds. There's still a record number of dry powder, and so it'll be interesting to see what happens in 2023 and beyond. As far as distribution of deal sizes, it seems that it's remained largely unchanged year over year. Next slide, please. Now, there's been an interesting phenomenon over the past year. And so surmising from the information, the number of angel investments has decreased by over 40%. And so the total capital invested is also decreased by 50%. And I think what explains this phenomenon is that a lot more institutional investors are focusing on earlier stage investments because of the competition from the crossover funds in Series A deals and beyond. And so what that also implies is that the valuations at those stage were highly competitive. And so you're seeing that earlier and earlier angel investors are getting crowded out. And so what are the ramifications of that in the long run? Not sure. I think the next few years we'll find out about their runway. If it's between 18 to 24 months, they may need to raise money again. But it's an entire shift in philosophy where institutional investors are willing to take a risk on startups that haven't achieved product market fit. Next slide, please. Now, when you look at the broader tech ecosystem, software continues to dominate as it does historically. So although the entire market has pulled back, as I mentioned before, the software has only pulled back about 25%. And so deal sizes, of course, have dropped down as well. And that's a broader, that's a sign of the macroeconomic headwinds that I mentioned before, but still record highs in comparison to 2018 to 2020. Next slide, please. Now, how's that impacted the university tech spin-out ecosystem? I think it's followed a similar pattern in which total investment dollars has pulled back as well. So if you look at it, deal count is down by 22%. average deal size shrunk by 14%. It's pulled back by about a third in terms of total investment dollars. But then again, when you zoom out, you look at the long-term picture, university and investments in university tech spinouts have never been higher. And so I think that's a trend that we expect to continue. But the reality is that the market has changed fundamentally. And it'll be interesting to see what happens in 23 and beyond. Next slide, please. I think this is always an interesting slide. How does the university ecosystem differ from the broader tech market? And I think the fundamental difference is that physical science startups are significantly more funded than software-based investments. And the shift in terms of the year-over-year difference in which software funding has dropped by 50% is largely due to an outlier called Databricks, which is an open source software database from Berkeley. And so they raised multiple $1 billion, and so that skewed the data. And so across the board, it looks like the distribution between the type of deals have remained largely the same, but the average median deal size has stayed the same, has decreased, excuse me. And so what is interesting is that the early stage investment arm investment side between Series A to B has grown in terms of valuation. And so that just tells you that more and more investors, as I mentioned before, are focusing on earlier stage investments due to valuation concerns or increased competition across the board. And so sorry, the screen is gone. Next slide, please. Great. And so when you unpack the university spinouts in terms of total deal value, there are a few large players, as I mentioned. What's interesting to note, I think in the audience questions beforehand, is that there's been a rush of investment in Climatetech investing. And so if you notice in the physical sciences section, almost $1.5 billion is constituted by Climatetech investments. So there's a direct air capture company, a long duration energy storage company, and Form Energy that's based out of MIT, and Mainspring Energy as well. And so the distribution is largely focused on Climatetech, which has contributed to most of the physical sciences investments. But there's still some investments as well in terms of large valuations from software-based companies. It's interesting to see that AV Labs there. That's more of a blockchain investment. And there's been a decreased shift in investing in that ecosystem as well. Next slide, please. Now, I think the biggest change year over year, as I mentioned before, is that an increased focus in Climatetech investments. So if you notice the most frequent investors across all categories, they tend to focus almost exclusively on Climatetech. So Breakthrough Energy, Collab Fund, Impact Science Ventures, Fine Structures, Shell Ventures from the corporate side. High level, there's an increased focus on Climatetech. Part of it can be constituted through enthusiasm from the government through the CHIPS Act and the IRA. But in general, there's a broader push for these type of investments in the past few years. Now, in terms of the early stage investments, this year Plug and Play has again dominated the ecosystem. They tend to seed a large number of deals across the board. OUP, of course, is one of the most active investors in the university ecosystem, where we mainly play in the early stage section. In terms of corporate investors, Intel still tends to focus on, let's say, compute investments that help sell chips. In the non-software sector, it's interesting to see that Alumni Ventures, as well as Impact Science Ventures, are mostly constituted for the non-software investments, which primarily include climate. Next slide, please. I think that's it for my section.
So actually, before we go on to that, and actually either you or Nabil can maybe answer some of these questions. So one question was, if you break this down by quarters or by half of a year, was 2022 similar to life sciences in that the first half of 2022 was at historic highs, but slowed dramatically in the second half of 2022 for tech?
Yeah, I don't have a slide showing that, but yes. So as I mentioned on the first slide from the section, deal count has dropped almost in half compared to Q1. And so there's been a dramatic pullback. Total deal value fell by 55%, deal count fell by 42%. And I think it was just a reaction to the public market correction. And usually there's a 3 to 6 month lag between the private and public markets. And so it's a similar shift. And so far in 2023, we've also seen a slowdown. So there's a continual impact.
Okay. And then another question was about the 10 largest deals represent 20% of total funds. How does that compare with prior years? Was it similar to that, or were we just seeing some just really huge deals, or was it this actually a smaller amount of the percent of the total funds?
I'm happy.
Yeah, go for it.
Yeah, I'm happy to take this one. So we did report on the same metric last year, and surprisingly, it is down slightly on both fronts. So fewer deals representing a fewer percentage. However, what's still surprising to us is it's still 20%. Like last year there was fewer deals making up a bigger percentage, but this year, despite a broader downturn, macroeconomic headwinds, less funding. University spinouts, there still seem to be pretty big deals out there, even excluding some of the big outliers that we had discussed, still making up a significant portion of the total funding out there.
Yeah, and I'll also say those outliers are less. For example, last year CFS raised $1.8 billion, and so that really skewed the data quite a bit. And we also saw a large number of investments in compute, so data infrastructure, which is not as common in the past year. So if you look at the 3 largest deals of this year, they're all loosely related to climate. So whether it's a 3D printing company for green construction or long duration energy storage, as I mentioned. So it really shows sort of the investor sentiment for the past year, and kind of shows the shift in thinking of in the year over year.
And one of the comments we had was, sorry, go ahead.
I just wanted to highlight, there is a point to be made that given that, venture investors have money in their funds, there could be a ongoing concentration in the new investments that they make, because there'll be few investments. We can, at least for the life science side, we may see that you still continue to see those large deals happen. And so they still be there, but there just will be fewer of them, just because the bar for the investment may rise as the overall market tightens.
Right. And then one of our attendees also commented on the fact that, you were talking quite a bit about, some of these outliers, and we do look at medians, obviously the kind of median where everything's playing as well. Anything you want to comment on about that within the tech data set, either Ajay or Nabil, because obviously, where we mostly live is probably not so much in those outliers, though, of course, all venture funds are looking for those large outliers eventually with some of their portfolio.
So can you repeat the question?
Well, so the question is, in the data that you just presented with regards to tech, you mentioned a number of these kind of outliers as far as financings that happened, but that obviously the vast majority, don't lie in that outlier, a part of it. But we do concentrate quite a bit on what ends up being kind of more the median area as far as financing trends with regards to companies. And does what you related with regards to what you're seeing in tech, follow with kind of where, most of the data is, not just these outliers?
Yeah, decreasing deal sizes are mostly the norm. Those investments are typically very late stage. And I think the expectation for many of those companies, at least last year, I think there's still an expectation to go public within a few years. I think, I don't have the data on top of me, but I think what would be interesting is to know about the deal timing. Like, did it occur in the first half of the year versus the second half? And I think that would tell 2 different stories.
All right, thanks so much, Ajay. Nabil, we'll pass it over to you for the state of biotech public markets.
All right, thank you. So in this section, we're going to focus on what's going on in the biotech public markets. And I think most people already know this anecdotally, but the numbers themselves are still a bit shocking. IPO count was down across all sectors, including in biopharma. And as public market cap erosion and poor performance of specifically the 2020 and 2021 class of IPOs, they basically blocked opportunities for companies to go public. And so after 4 successive years of 50+ venture-backed IPOs, there were only 19 IPOs in 2022 globally in biopharma. And actually, in 2021, there was nearly 100 IPOs. So that's a significant slowdown in IPOs. And this is what ultimately drove overall biopharma exit value down to its lowest level since 2018, down 65% year over year, to just 31 billion, which is what you'll see in that chart on the right-hand side. Of those 19 IPOs, 11 were in the US or Europe. And a common theme they all shared was having a significant crossover investor or top venture investor in the syndicate who also participated heavily in the IPO. In the later slide, we'll get into crossover activity as well. But a second theme was also a focus on neuro, which represented 4 of the 11 IPOs, while oncology only had 1 IPO in 2022. I'm sure this is something, Anurag had already commented on this a bit earlier, but even on the private side, we've obviously seen oncology become less interesting over time. And then the last broad theme we observed was a focus on early stage technologies. And I should point out that by early stage, we mostly mean phase 1, with 5 of the 11 IPOs being phase 1 stage companies, and only 1 was preclinical. And I'll also mention that, of all the stages of development, preclinical technologies had the worst decline over time. And what this suggests is that the public markets are much less receptive to technologies that have not been somewhat de-risked or they're less proven out. And just in 2021, so many VC-backed IPOs were preclinical, maybe 20 to 40%. And this year there was only 1. So that's pretty significant. And the last point I might make on this slide is that IPOs had a flat median step up from the last private round to the IPO valuation. And obviously, that is not attractive for crossover investors. So if we go to the next slide, we can get a little bit into what those crossover investor trends were. So the shortfall in biopharma investing was primarily driven by 2 main factors. And one of those was crossover investors who funded way fewer crossover rounds in 2022. And Anurag sort of hit on this earlier as well, but with much less crossover funding and fewer IPOs, naturally, companies need to stay private for longer, and they may need to raise more VC funding to extend their runway. And so basically there's a funding gap because crossovers are now looking at value investment opportunities on the public side, now companies need to find that capital elsewhere. So what the chart here on the left-hand side shows is the number of crossover deals per quarter for the last 3 years. And the blue line represents the percentage of those deals that actually converted into an IPO. And the number of biotech crossover rounds fell by 62% in 2022. And on average, 1% of those deals converted to an IPO in 2022, which is down from an average of 20% in the year prior. And the second reason behind the large decline in biopharma funding in 2022 was because new investors simply demand more progress before funding the next round. And this is forcing more extensions or insider rounds and bringing the focus back to fundamentals, which for biotechs means the quality of your data, which we'll get into right after we hit IPO performance on the next slide. So everyone knows that biotechs have fallen. And I think the purpose of this slide is really to express the magnitude and the breadth of it. So the table on the left includes biopharma IPOs from the class of 2020, 2021, and 2022, broken out by gainers and decliners. And here we look at the aggregate performance through the first half of 2021, the end of 2021, and the end of 2022. And the artwork you see in the background is actually the performance of those 200 IPOs from their IPO date to the end of 2022. And so you'll see a lot of red there. Each line on the chart in that background is a company. And so this is just to give you a visual representation of the environment. And what you'll notice, and what's obvious here, is that not only did performance get worse over time, but the number of companies suffering also became more widespread. And this is basically the reason why there were so few IPOs in 2022, because it wasn't a very welcoming environment for new public debuts. So about a third of the companies that have declined up to the end of 2022 have lost 90% or more of their value. And median declines from Q2 of 21 to the end of 2022 nearly tripled, from negative 28% to negative 80%, while the percentage of IPOs declining also increased from 45% to 84%. But on the other side of that, despite widespread losses, this clearly isn't the case for everyone. There is some green on this chart, which means that there are still some winners, and those winners are rewarded accordingly. And although the percentage of gainers declined from 55% to 16%, the median gain increased to 50%. And so again, not to beat a dead horse, but the key differentiator for those winners is mostly the quality of their data, and we'll get into that on this next slide. So no matter what the macroeconomic environment is, the quality of your data is what will ultimately drive the value on the public markets for biotechs. The chart on the left shows the average enterprise value of US listed biotechs over time by the quality of their data. The height of each bar represents the average enterprise value, and each color from left to right indicates a different point in time. So if you look from left to right, it's showing you from December 2021 to February 2023. And the two buckets we've separated this out into are good data and not good data. On the good data side, what we see is everything that we've just discussed, which is that the exuberant valuations of 2021 sharply declined by the first half of 2022. But what we want to focus on here is that for the companies that announced good data, they gained back nearly 70% of their lost value. And so what this means simply is that good data is still king. On the right-hand side, we included an example of one of the few companies that had good data in 2022. Dice Therapeutics is an OUP3 portfolio company that rose 62% on the day of the data readout, which represented a total 122% increase from its IPO value. And on the other side of that coin, the market also reacts accordingly to data that is not good, of course. And you'll see that on the right-hand part of this graph, that these companies fell over 80% from their valuations once they announced data that was not well received by the market. And over time, you see that their value actually hasn't changed much at all since then. And so what this means is that there's a shift from the shift you see from December 2021 to the first half of 2022 is the market once again valuing biotechs based on fundamentals. And those exuberant valuations were the markets essentially pricing in the best case scenario during an era of cheap money. And now, as the cost of money rises, fundamental valuation models must price in higher discount rates and higher costs, which is likely why these companies may get about 70% of their value back, but not necessarily 100. And with companies like Dice, it was good to see the market react favorably to a positive outcome, as this may restore some sense of normalcy back to the public markets. And we hope this trend will continue as positive news like this could help reinvigorate the IPO markets. So I do have one more slide here. This is more of just a visual representation of what I had said earlier about preclinical data suffering the most, while if you look all the way on the right-hand side for phase 3 data, you'll see it dropped, but then rose back significantly. And so basically what the visualization is telling us is that the market continues to value further along or more de-risked technologies than earlier stages.
Great, Nabil. It's really great to see what's going on with the how the data is basically correlating, with what's happening with the stock prices in the biotech market. I think that's probably of interest to a lot of our folks. I do have a question actually, and maybe for this actually may be more for Anurag, on the biotech, on the companies actually going IPO. In addition to kind of the financial market situation, are we also seeing companies, reflect on whether they're going to IPO based on increasing pressure with regards to drug pricing legislation? Is that a factor that's also coming into play here at all?
Yes, I mean, it is coming in. It's something that is on top of the investors, along with the Inflation Reduction Act, which has some challenges on Medicare negotiations for small molecules. I think those are part of the discussions. However, unclear of how many of them are going to get passed and get adopted. And so it is a question, but I wouldn't say that I have seen any deal fall through or been significantly discounted specifically for that. But I think the emphasis on that continues to rise. And I think over the next couple of years, it's going to shape a lot of decision making, especially in the small molecule space.
Great. Thank you so much, Anurag. Ajay, we'll go to you.
Thank you. Next slide, please. Great. And as I alluded to before, the public markets have had a severe impact on a potentially serious impact on the private market. So if we look at public market performance, this particular index is just an aggregate data of most of the software companies that are public. You can see that it's actually dramatically decreased from its peak in the at the end of 2021. And so it's almost 81% down. And so that's had a significant impact on EV in revenue multiples, which is the method of which private market investors value private companies. And so the average multiple has decreased by almost 50% as a result. And so I think I don't want to make any declarative statements, but 2022 was a monumental shift. It may have ended the 13-year bull market. Inflation and rising interest rates has impacted all the sectors, as Anurag mentioned. Valuations are down 55%, as I mentioned. And I think what to expect is that the private markets will be affected. And we're already seeing that effect in the Q1 of 2023. Next slide, please. In terms of impact in 2022, I indicated before that Q3 and Q4, there was a huge drop off in terms of early stage investment. I think that the public market has specifically impacted the late stage investment activity and exit activity the most. So according to this data, the estimated number of exits are almost cut in half towards the end of Q4. Crossover activity is limited as well. These are investors that are hoping to take companies public. And 2021 marked the beginning of the SPAC mania. And so many of the university tech SPACs and IPOs are down over 80% in market value as well. There are a few prominent ones such as Desktop Metal, Aurora, and Too Simple, which are both focused on autonomous vehicle driving. But I think this kind of represents the broader market ecosystem. Many of these companies may have not been ready to go public, but they represent an early liquidity option for early stage investors. And so now there's going to be a trickle down effect that we expect to continue to happen. Next slide, please. Now, in terms of the university ecosystem, it hasn't quite affected most of the deals yet in terms of affecting valuations at the end of Q4 2022. As you can see on the right side, so this chart is segmented in different stages. So seed stage investing on the left. In the middle, it's let's imagine Series A to B to C. At the late stage, these are later stage investments that are hoping to go public. You could see that the mean valuations for the late stage investments are coming down, and the early stage and seed have yet to be affected. And so what does that mean? Perhaps that in a few months' time that might change. There's essentially a few outliers that are skewing the data as well in terms of the early stage investments. You could see that a focus has been placed on the seed investments as a result of the high valuations, as I discussed before. And so we've yet to see the ramifications of the public market play out. But a few reasons can explain that why the private market valuations haven't been affected yet. A lot of these companies have a long runway, so they've raised significant cash runway. So hopefully they're private until the middle of 2024, and so they're hoping to get more traction. I think another explanation, which I'll go into next, is that there are a few particular areas of interest for investors known as hype cycles, in which there increased investment activity, which could explain why the private market valuations are completely distorted from the public markets. Next slide, please. Now, if you're not familiar, Gartner Research Group has coined the term hype cycle. This is taken from their particular research report. And so basically it helps you understand the perceived value of a given technology and how it evolves over the course of its technical maturity. And I think the way to reframe this is think about wind and solar. So solar cells took about 20 years to commercialize. At this point, it's a mature product and mature technology that is getting widespread adoption. But if you remember in the clean tech 1.0 era, there was a massive amount of investment and clearly a crash. I think we've seen in the past few years, there's other similar technologies that have had a similar fate. Let's say a little bit faster blockchain, quantum computing, autonomous vehicles, as an example, or innovation, too simple, has lost over 80% of the value. And so the entire point of this is that there's a few lessons you can take away. Is that excitement doesn't always correlate into actual value or exited value for the investors, and perceived value from investors does not necessarily correlate to the public market. So just because the public market is declining by 80% doesn't mean that in the private market that the valuations are hitting record highs. And what you're seeing in 2023 is an increased emphasis on generative AI because of ChatGPT and OpenAI. Last year in particular, there's an increased focus on Climatetech. So direct air capture was a topic of focus. You're seeing a lot of nuclear fusion companies that are coming out. And so many of these technologies are going to take a long time, maybe 10 or more years to mature. And so we think that there's going to be a lot of lessons. There's going to be some winners, but more often than not, in these periods of peak expectations, peak inflated expectations, there's going to be a lot of fallout, in our opinion. Next slide. Now, I want to discuss Climatetech, which has been part of the hype cycle for the past year or so in the physical sciences sector. This is basically a breakdown of the general financing activity across both university investments as well as the broader ecosystem. And so what you see is that the distribution between year over year is quite the same. And the typical investment in the sector is still pretty stable, around $30 billion or so. But what's interesting to me is that a lot of the investments are influenced by the university spinouts. So each section has a number of well-known companies that have originated in the university ecosystem. And so when you're thinking about where are investors placing their dollars in Climatetech, it really crosses a spectrum. So I think a lot of the story is about direct air capture, carbon technology to suck out air. But there's also increased focus on mining technology or extraction, to focus on obtaining critical minerals that are important for the energy transition, or the end of the spectrum where you're thinking about recycling used batteries from electric vehicles like Ascend Elements. There's a broad spectrum. There's an entire new industry that is being born in the venture industry. A lot of it's driven by enthusiasm around the IRA as well as the CHIPS Act, as I mentioned. So government-sponsored focus on climate technology has influenced a lot of investments in projects that are actually not quite fully technically de-risked. So all of these companies have raised a significant amount of funding. The reason why is they need to demonstrate their technology. So many of them have built lab or bench scale prototypes. Now they're building entire pilot plants. And so it's an exciting time in the climate sector, but also might be, might be part of the hype. And so we don't know the full answer until the next few years, but it'll be interesting to break it down and to reflect on this moment and see if many of these companies actually survive. And so hopefully they do. Next slide. As I mentioned, in terms of the university ecosystem, it's played an outweighed influence on the climate tech ecosystem. So from 2020 to 2021, the average investment grew, the total investment grew by 300%, whereas the broader market grew about 90%. I think what's interesting is that historically that university spinouts accounted for 10% of the capital invested in the sector, but now that's shifted to 24%. And I think the answer there is probably that many of these technologies have been de-risked to a certain standpoint. So they've been in the lab for a while, there's a bench scale device, and there's plenty of research behind it. But there's also a proliferation of new organizations like Activate, Breakthrough Energies, or sponsoring fellows. There's all kinds of non-dilutive dollars that are not just from the government that are influencing an investment in the space. And so there's a rise of impact investing, which has supported the technologies that are coming out of the lab, which is necessary. I think although there's been a pullback, it's followed a similar pattern to the rest of the tech ecosystem. Broader climate tech deals have declined by 25%. It's too early to tell how that 2023 will be impacted. But I just got back from RP investor conference, and there's never been more investors in the space. And so we'll see how 2023 shapes out. Next slide, please. Last slide on university climate tech spinouts. An interesting fact is that the total valuations, the average valuations, is about 3x at those of the climate tech spinouts in the broader ecosystem. And so, as I mentioned, this may be due to the fact that many of the technologies are de-risked to a certain standpoint, or there's enough proof points to give investors comfort. But as a result, they have 2 to 3x the value of the broader ecosystem. And so, this is kind of similar to the peak of Climate Tech 1.0. And so it remains to be seen, as I mentioned before, whether this trend continues, if the valuations would come down. In our experience, in our experience of witnessing Series A and beyond climate tech deals, there's been a massive capital investment, high valuations. And so many of these companies have long runways, so 2024 and 2025. So we won't see the ramifications of the public market for a while. And there's also increased dry powder for these sectors. What's also interesting to me is that there's 2 fundamental differences from Clean Tech 1.0, in my opinion. First is increased corporate interest from individuals down to an overall broader interest in general. And then 2, the number of crossover investors, so TPG Growth, Capricorn, others that have large amounts of capital where they can invest $200 to $300 million at a time to support these initiatives. And so there's a rise of these massive impact-oriented climate funds, which hopefully will support the large-scale pilot projects and large-scale demonstrations as required to continue the ecosystem. Next slide, thanks.
Great. Thank you so much, Nabil. I'm going to hold you, sorry, Ajay. Apologize. Nabil's writing an answer, so I was looking at his name.
Not offended.
Thank you so much, Ajay. I actually am going to hold you to, to going back to that's particular slide where you're talking about, we'll see what it's like in 3 to 4 years. And I think we should do that comparison with regards to those companies and see what actually happens with them. We don't actually have any questions with regards to climate tech. We do have a couple of questions. So a number of people had written questions beforehand, and we answered a lot of those. But I did want to come back to 2 of those that I had written beforehand. I know we're already past the hour, so thanks for those of you who are sticking with us. One of those questions, and this question actually is to Anurag. It would be interesting to hear your comments on trends regarding using an LLC holdings company in biotech and what that, and perhaps you can just comment on that from a VC point of view.
Yep. LLC, again, because of the tax reasons of how you treat the profit, is not the desired structure for VCs. I think most companies taking VC dollars end up converting to C Corp. However, as a startup, you may start as an LLC because it's easier to set up. But if you are taking some VC dollars in any significant way, it may be time to convert C Corp, and the investors should help you in doing that.
Great, thanks. Another question that we had gotten beforehand was that many startups are opposed to paying milestone payments. What is the panel's opinion on the position startups are taking? And I'm going to answer this one just because I used to work in tech transfer, and so I'm not actually sure which area the person is talking about with regards to milestone payments, but in general, milestone payments are incredibly common in the therapeutics field with regards to startups out of universities, but not incredibly uncommon in other fields, or if they are in the other fields, they're fewer and lower dollar amounts. It is very common in the therapeutics field. So if that's what the person is referring to, I think people are pretty much set that that's part of what comes with a licensing deal with regards to the therapeutics fields. But in the other fields, it just really heavily depends on what's happening otherwise with the license itself. So,
and the company should be excited to pay the milestones because that means they're making some clinical progress and creating significantly large value. And
exactly.
some of our
so hopefully their value has gone up significantly at that point, right, Anurag? All right, well, thank you so much, Ajay, Nabil, Anurag, for being our panelists today, for putting all this work together, especially Nabil and Ajay for all the heavy lifting with regards to all of those slides, and Anurag as well. Thank you to our audience for joining us and staying for so long. We hope this was informative for you. Feel free to follow up with any questions. We do have that survey that we always send out to you. It's very short, so please fill it out and let us know how we're doing and suggestions for future webinars as well. In the meantime, everyone, have a terrific day, and thank you again for joining us.